I think we can start the session. Hopefully I'm audible. Yeah. So good evening, everybody. Today, we have reached to the fourth and the last session of rapid revision of business economics for CA Foundation. After the discussion on first, fifth, second, and third chapters of business economics, let's come to the climax of this subject, which of course is the culmination of many things that we have learned earlier with a new edition of different types of markets and how the market strategies should be, or the pricing strategy should be in different types of markets, is the subject matter of this particular chapter 4, we can say. This has 3 units, and the first unit briefly tells us about different types of markets, but most importantly than that, it tells us about the concepts of revenue. So far, we have discussed about the concepts of demand, supply, consumer behavior, theory of production, theory of cost. In addition to that, we need to also understand some of the basic aspects related to revenue, which is the sales or income or whatever the name we give, the benefits that a firm earns by selling its goods or services in the market. So the concepts of revenue are very important, and they are discussed in unit 1. And in addition to that, there is unit 2, which broadly is about determination of prices, which is actually a continuation of what we already know, the theory of demand and supply. Only thing is, what happens to the prices and equilibrium quantities when the demand and supply change a little bit. Very crucial and important aspect, but very easy also if we just can draw a couple of graphs. But the culmination of all of this will go into the price determination in different types of markets. So these are the 3 units within this chapter 4. Let us start with unit 1. And as usual, we'll go with the summary of this unit 1 in a nutshell. What are the various aspects related to different types of market? First and foremost point says economic goods. This is something that we already have identified earlier. They are scarce in relation to their demand and have an opportunity cost. Opportunity cost means the goods can be used for other purposes also. So the goods and services in general, whenever they are in market, have multiple uses and they can be used for multiple purposes. And naturally the wants are unlimited, but the available resources to satisfy those wants are limited. So naturally the goods always are scarce and have opportunity cost. And unlike free goods, they are exchangeable in the market and they command a price. That is an important point. Normal goods, free goods, let us say if at all, then free goods like water, oxygen, normally what is available. Of course, water not in water bottles, the water available in the rivers and all, that is free. That does not have a price. If you want to just take a sip of water from a river, nobody is going to ask you any money. But if the same water has to be drunk from a water bottle, then that is exchangeable commodity and that commands a price. So the water in a water bottle becomes an economic good. The water which is there in the rivers and lakes is a free good, natural good. So that is not an economic good. So simple difference once again is natural goods or free goods do not command a price. They do not have an exchange value. They do not have a market separately, whereas economic goods will have a market and they command a price. Now, what is price? Price is basically the money value. In other words, the purchasing power of an article expressed in terms of money. at what price a particular article has to be purchased, that's what is price. That's a simple definition. It is the purchasing power of an article expressed in the form of money. Then, what is value in exchange? This is what we have been using many times. That is exchange value or value in exchange. What does it mean? It is the basic price at which there is an exchange that is happening over the purchasable commodities. In simple words, that is a price. Exchange value is nothing but market price. If a particular water bottle is sold in the market for 10 rupees, that is the exchange value of that water bottle. If a particular pen is sold for 50 rupees, that is the exchange value of that pen. That is simply nothing but price. So price or exchange value or money value or the purchasing power of the commodity or article expressed in the form of money, all are same and all are the characteristics of economic goods, simply speaking. And these economic goods are sold and bought where? That's what we call as a market. Market is a whole set of arrangements for buying and selling of a commodity or service. And buyers and sellers bargain over a commodity for price. Bargain, once again, does not mean that always there should be a physical interaction between the buyers and sellers, and buyers should always negotiate with the sellers for price. That sometimes can be expressed, sometimes it can be an implied bargain also. But nevertheless, in a market, there will be a set of people who are buyers and sellers and who are ready to participate in the market for exchange of various goods and services. That's what is market in a simple sense. And what are the elements of the markets in general? Again, normal things. Market will consist of what? Market will consist of buyers and sellers. Naturally, yes. A product or service should be there, which can be exchanged. Then there should be a bargaining for a price in general. Knowledge about the market conditions should be there for buyers and sellers. If it is a perfect market, then both buyers and sellers will be equally knowledgeable, though it is not practically possible. But still, buyers and sellers know about the product, know about the market conditions, is one of the assumptions of a good market. And most importantly, one price for a product or service at a given point of time. These are the elements of market. Once again, more theoretically, these can be considered as elements of the market. Practically, the market is not something that can be just seen or defined or drawn a boundary for. It can be a small vegetable market, or it can be something like the entire globe acting like a market sometimes. It all depends upon what transaction we are looking at, then the definition of market automatically changes. In a small road, on the road, if a few vegetable vendors are selling their vegetables, potatoes, tomatoes, onions and all, that is also a market. And in the international market, when gold or other things like international valued commodities, diamonds, those things are all sold, that is also a market. So the size of the market, the geography of the market might definitely change. And naturally, the dynamics of the markets also definitely will change from time to time and place to place. So we should understand the market as an abstract concept rather than a concrete thing that we can see at any point of time. For example, stock market, whenever the news channels talk about the stock market, they only show the BSE building, the Bombay Stock Exchange building. Does it mean it is the only market in India? No. There is National Stock Exchange also, but they don't show the building. But by the way, National Stock Exchange or Bombay Stock Exchange, they are not, buildings are not representative of the market. The system, the total set of arrangements which is made for the purpose of buying and selling of securities is stock market. Where vegetables are sold and bought, it is vegetable market. Where fish is bought and sold, it is fish market. Where gold is bought and sold, it is gold market. Where foreign exchange currencies are bought and sold, it is forex market. Like that, different commodities can be bought and sold. Services can be bought and sold in a market. And there will be so many dynamics of the market broader than just the name itself. So we cannot take a rigid approach towards understanding the market. Market is a very powerful and a very pervasive term and broad in approach at a conceptual level. We need to understand that way. Now, in general, at a broader level, the markets can be classified into product markets and factor markets. Product markets means, like we are talking about, the normal products, agricultural products, the products that we use normally, the FMCG products, or we buy something like automobiles market. These are all product markets, where goods and services are bought and sold. That is a product market. Factor markets are different. Factor market means where the factors of production are bought and sold. And what are the factors of production? Land, labor, capital, and organization. Where those are bought and sold, that is called factor market. For example, where the capital is bought and sold, where the capital is issued, that is a factor market. For example, if a company is coming out for an initial public offering called IPO, that is a factor market because it is raising a capital that belongs to a factor market. Product markets are different, where normal things, everything that we buy on a daily basis, normally, wherever, that is an example of product market. Factor markets are those where the labor are offering themselves for the rendering of services to various organizations, or where the land is available for sale or rent, that is a factor market. Where capital is bought and sold, capital is issued and purchased, that is also a factor market. So this is the broad classification of markets. One is product markets, the second one is factor markets. Of course, the factors which determine the type of the market are many. We cannot actually generalize them, but in general, the nature of the commodity, the size of the production, and extension of demand will determine what type of market a particular place will be determined. These are the general factors. Depending upon nature of commodity, the market types will be different. The size of production also will have an impact on the market. And the extent of the demand also will have an impact on the market and type of the market. And there are various ways in which we can classify the markets into different types. They can be classified on the basis of area, on the basis of time, on the basis of the nature of transactions or regulation or volume of business and types of competition. Different classification of markets can be understood like this. Let us say on the basis of area, how can we generally classify them as into local markets? The small local kirana shop to which we go and buy our groceries is an example of local market, or a vegetable shop at the end of our street is a local market. Regional markets could be related to a particular city or a state or a particular district, that is regional market. For example, for a district, let us say agricultural market, mandi, is an example of regional market. National market means the all India level market. For example, in Indian context, throughout the country, the goods and services are bought and sold. That is a national market. International market naturally represents entire globe. This is the classification of the markets on the basis of area. On the basis of time, how can we classify the markets? Very short period market, very short period, that is also called as market period. These other names are also important to be noted. Very short period is also called as market period. For example, for the particularly market period or very short period, this is the two different names. Same way, long period is called as the secular period. So these are the other names also we should remember, because in the questions they may use any of the names. Very short period market is that which is generally for perishable commodities, something like milk, eggs, vegetables, daily things which do not have much of life. So that is very short period market. Short period market will be for some more longer than the very short period. We cannot exactly define how many months is short, how many days is short, very short, not like that. But in general, the classification is like this. Long period and very long period or secular period market is that which will have a very longer period market for something. For example, let us say an aircraft business. Aircraft business cannot be working in a short period market. Today, if we order an aircraft, Boeing, Airbus, or Rafale, what we have seen earlier, like Dassault has produced and sent to India, it will take 2-3 years of time to at least build them. So it is not a very short period market or a normal long period market also. It is a very long period market. So on the basis of time also, depending upon the nature, the markets can be classified into very short period, long period, and very long period. Other names you have to remember also. Very short period is also called as market period. Long period is also called as secular period. And on the basis of transactions, we can classify the markets into spot market and future market. Spot market means where the settlement happens immediately, where the delivery happens immediately. If I purchase something, you go to a shop, purchase a pen. You give the money, you take the pen. Settlement completed, immediate. That is spot market. Future markets are those where the agreement happens now that I will buy something from you after some time at a particular price, but the purchase actually, the settlement or delivery of the goods has not yet happened. That is called future market. Usually, there are many commodities which have future market, gold, currencies, shares, all of them have futures market. Even in India, agricultural produce also, some of them have futures market. So spot market is something where immediately the delivery happens, settlement happens. Future market is something where agreement happens now, but actual delivery happens in future. That is the difference between those two on the basis of nature of transaction. Of course, on the basis of regulation, broader basis, we can say regulated market and unregulated market. The roadside vegetable vendor is unregulated, but stock market is a regulated market. There is a SEBI which is regulating the stock market in India, Securities and Exchange Board of India. So regulated and unregulated markets is the classification on the basis of regulation. Again, on the basis of volume of business, everybody knows this, we can broadly classify them as wholesale markets and retail markets. Where the volume is where the volume is high, that can be called as wholesale market. Small individual actual consumers where they go and purchase, that is a retail market. But now our actual core focus on the classification of the markets is about on the basis of competition. On the basis of competition, how the markets can be classified. There we can classify the markets into perfectly competitive markets and imperfect markets at a broader level, which are perfectly competitive markets and imperfect markets. Then imperfect markets can further be divided into monopoly, monopolistic competition, and even oligopoly. So at a broader level, we can have two-level classification: perfectly competitive, imperfectly competitive markets. And imperfect competition can further be classified into monopoly, monopolistic competition, and oligopoly. That is the classification of markets on the basis of competition. And this is what is going to be our core area as far as chapter 4 is concerned. Now moving on to the revenue concepts, very important revenue concepts. Of course, normal concept of total, marginal, average, if you know, the same thing applies here also. What is total revenue? The total revenue means the amount of money which a firm realizes by selling a certain units of a commodity. Simply, how much price that it charges for a particular commodity price multiplied with the quantity, that is what is total revenue. Total revenue is nothing but price of a commodity multiplied with the number of goods of such commodities sold by an organization. That is total revenue. Then what is average revenue? That is a revenue earned per unit of output. In other words, total revenue divided by the number of units which is sold is average revenue. Is it not price? Of course, yes. So that means what we can also conclude, average revenue is nothing but price. Price as an other expression of average revenue, unless and until there are different multiple products a particular company is selling, or it is selling at different prices to different customers, showing price discrimination. Normally, with those exceptions apart, under normal circumstances, average revenue is nothing but price. That is the revenue earned per unit of output, which is nothing but total revenue divided by total quantity sold. Now the most important concept of marginal revenue will occur. Marginal revenue is what? That is a change in the total revenue resulting from the sale of an additional unit of the commodity. Always marginal means 1 plus. One additional commodity when it is sold, what is the additional revenue generated? That is called as marginal revenue. Normally, marginal revenue should be price, but it will not be exactly price. So there will be a relationship between the marginal revenue and average revenue like this, a very important relationship. Marginal revenue is equal to average revenue multiplied with E minus 1 divided by E. And what is E here? That is price elasticity of demand, which we discussed in chapter 2. So what is the relationship between marginal revenue, average revenue, and price elasticity of demand? That is the equation we should remember. Marginal revenue is equal to average revenue multiplied with E minus 1 divided by E. For example, what if elasticity of demand is equal to 1? Then marginal revenue will be 0, because 1 minus 1 is 0. 0 divided by anything is 0. But if it is 0 divided by 1 is 0 definitely. Multiply with AR, it will be 0. So marginal revenue will not be anything. No additional revenue will be generated if at all exactly the elasticity of demand is equal to 1, which is unitary elastic. If at all E is greater than 1, then what? Then definitely marginal revenue will be more than average revenue, because E minus 1 will be greater than E in that case. So marginal revenue will be more than average revenue in that scenario where elasticity of demand is more than 1. That means for those situations where the products are more price elastic. Marginal revenue will be more than average revenue. Sorry. Marginal revenue will be more than average revenue. When marginal revenue will be less than average revenue, which will be less than average revenue when E is less than 1. So in that case, marginal revenue will be less than average revenue. So it will be negative also in that case, because if E is less than 1, anything less than 1, so definitely this becomes negative. If this becomes negative, marginal revenue also becomes negative. That is how marginal revenue and average revenue are related with each other. Simple formula: marginal revenue is equal to average revenue into E minus 1 divided by E. And the total revenue will be maximum where the elasticity is equal to 1. When the elasticity is equal to 1, the total revenue will be maximum. That is another relationship we can say, but not about marginal and average, but that is related to total revenue. Where the elasticity is equal to 1, there the total revenue will be maximum. We also understood how the elasticity of demand will have an impact on the total revenue earlier, but that was in the form of total expenditure for a consumer or total revenue for a producer. What happens when elasticity is equal to 1? What happens when elasticity is greater than 1? And what happens when elasticity is less than 1 for a product of more elastic, less elastic, or unitary elastic? When it is unitary elastic, total revenue remains constant. But that is the maximum level where the elasticity is equal to 1 that a company or a firm can get maximum revenue, or total revenue will be maximum at that level, we can say. Now, there are two very crucial principles here to be noted, very important principles, always to be remembered and understood, which have to be applied also at some questions. If a firm's total revenues are not enough to make good even the total variable costs, then it is better for the firm to shut down. In other words, a competitive firm should shut down if the price is below the average variable cost. If the price of a particular organization's commodity is below the average variable cost, if it is less than average variable cost, there is no point of even manufacturing. It should not manufacture. What it should do? Shut down. That automatically means what? If the price is above average variable cost, the firm should not shut down. It should continue to operate, though it incurs losses. Why? Because at least it is going to cover some portion of the fixed costs. Why? Because fixed costs are going to be incurred even if you shut down. That is why, to cover some portion of fixed cost, if a firm is able to get an average revenue or a price of more than average variable cost, it should continue. If price is less than average variable cost, simply it should shut down. That is a good phenomena when the price is more than average variable cost, irrespective of whether there is profit or loss. But definitely when price is less than average variable cost, there will be loss only. Not only that, the firm should shut down. That is one important principle, behavioral principle we can call it. And another important principle is where the firm will earn maximum profit. What is the point at which the firm will earn maximum profit? Where the marginal revenue is equal to marginal cost. This is another principle to be always remembered. Marginal revenue where it is equal to marginal cost, that is the place, that is the equilibrium point for a firm where it can earn maximum profit. That is the level of activity which a firm should operate. What level of activity a firm should operate, if anybody asks, then it should be at a place where marginal revenue is equal to marginal cost. These are the 2 points to be noted, very crucial points. What are those? One is, a firm should shut down if the price is less than average variable cost. 2, a firm makes maximum profits when marginal revenue is equal to marginal cost. And another very crucial thing in this chapter is marginal revenue is equal to average revenue into E minus 1 divided by E. What is total revenue? What is average revenue? What is marginal revenue? Are also part of this particular unit. These are the concepts of revenue which are discussed here. In addition to that, some general information and knowledge about what is a market, what are the classifications of the market, different types of markets are also discussed here. That was unit 1 of chapter 4. Now moving on to the unit 2 of chapter 4. Main thing here is the determination of prices. Determination of prices, whenever we say in a market economy, that happens on the basis of demand and supply. Simply speaking, whenever we say price determination will always happen on the basis of demand and supply. And we know demand line will go downwards, supply line will go upwards. And wherever the demand and supply curves are intersecting with each other, that is the equilibrium price. So in this example, 2 rupees is the equilibrium price and quantity approximately is 35, where the quantity is there on the x-axis. So equilibrium price and quantity can be identified with the intersection of demand and supply, that we know. But now only point is we have to apply that concept in different variety situations. And lot of such questions can be expected in the examination. They will be very easy only when you put pen on paper or pencil on paper and draw the graphs. If you want to imagine what happens, that increases, this decreases, that increases, this increases by more than the other decrease, that decreases by more than this increase, full confusion. Nobody can actually answer those questions. Confusion only comes when there is no clarity, and confusion only comes when there is no conceptual understanding. So for understanding this demand and supply conceptually, very easy, nothing difficult, nothing very rocket science. Simply all that we need to do is practice drawing some graphs. They will be horrible, let them be, no problem, nobody is going to look at them. I am also drawing horribly, I know that, but are we getting the result? That matters. So what are the changes that can happen in demand and supply? According to these changes, what happens to the price as well as quantities? That is what we should look at. Let's first let us look at these 4 different situations. First of all, there could be an increase in the demand, means demand curve could shift rightwards. There could be an increase in demand. There could be a decrease in demand, or there could be an increase in supply, or there could be a decrease in supply. Any of them is possible. What happens because of each of them? Directly we can observe. You don't have to see the graphs and get confused. You can just draw them. That's the simple thing, easiest thing to draw. Just take this L. First, what I was asking, increase in demand. Increase in demand means only demand, not supply. When you say increase in demand, only demand, not supply. First thing first, always you draw this X. Easy. One downward thing is demand, upward thing is supply. That is no. Now, what is the change? The new thing you draw. What is the new change? New thing, increase in demand. Increase in demand means what? That goes upwards. But prior to that, mark the original equilibrium point. Let it be there. Now, increase in demand means what happens? Demand curve will shift upwards. Now, what is the new equilibrium point? Draw that. What is the big deal in that? What happened to price? Increased. What happened to quantity? Increased. Done. That's what happened. When there is an increasing demand, what it will cause? It will cause an increase in equilibrium price as well as increase in quantity. For that, we should by heart that. No need. We just draw it and you can get it yourselves. We have to just get the answer. Nobody needs to tell us. Nobody needs to give us a table which we should by heart. That is nonsense. If we do that, naturally we will get confused. There will be a very good chance that we will put wrong answers in the exam. That is increase in demand. So naturally the opposite, let us look at decrease in demand. Story is same. First demand, then supply. First draw whatever the equilibrium is. Now what is the new story? Decrease in demand means demand curve came leftwards. So what happened? Original price got reduced. Equilibrium quantity also reduced. Done. So when there is a decrease in demand, that results in a decrease in price as well as quantity demanded. Proven. We don't need to by heart that. We just have to put on paper and know our results. Easiest way of answering. Many questions can be answered with this. And very important point also, price determination always happens in this way. And then increase in supply. Once we are used to that, we can just use it now. So now what is the original equilibrium point, wherever it is. Now what happened is increase in supply. Supply means this one. Increase means it goes rightwards. So what happened now? Increase in supply has reduced the price, but increased the quantity. That's what happened. That's what happened. Increase in supply, what happened? Decrease in equilibrium price, but increase in the quantity supplied. Equilibrium quantity increased. Done. That is third point. Decrease in supply. Opposite. Again, don't look at the graph. Just draw it simply. Normal, X. Then what? This is original equilibrium point. Okay. Then what? Supply decreased. Supply means this. Decreased means left. Then what happened? Then what happened? Price got increased. Quantity got decreased. This was the original equilibrium point. This is the new equilibrium point. So price originally was this. Now it became to higher. So price increased. Quantity got decreased. That's it. Decrease in supply is causing what? Increase in equilibrium price and a fall in quantity demanded. That is what is very clear from the graphs. We don't need to by heart at all anything. But this is what? Only one thing happening at a time. Either increase in demand or decrease in demand, or increase in supply or decrease in supply. Any one of them is happening at a time. Any one of them. Still we can draw the graphs and get it. Now what if there is a simultaneous change in demand and supply? Okay, little bit more complicated, but still it's okay. It can be just drawn, not a big deal. When there is a simultaneous change in the demand and supply, supply curve also should be changed, the demand curve also should be changed. Let us say here, both of them are increasing or decreasing, whatever the way it is. Whatever the way it is, simultaneous change in the demand and supply when it is happening. If you look at one direction, opposite direction also is clearly visible. So this also can be just drawn and observed, but only point is here, we need to be clear with size of the increase in demand and supply. Let us say once again, this is the original equilibrium, okay? Then exactly demand also increased by the same proportion, supply also increased by the same proportion. So ideally the price remains the same, but quantity increases. That's what happened here. What happened here? In this particular first diagram, price did not change. Price remained the same. Equilibrium price was still the same. When demand also increased in the same proportion, supply also increased in the same proportion, price remains the same, but quantity has increased. That is clear. That has increased from this to this. It has increased in this case from Q to Q1. Then, what about the second scenario? In this case, what happened? Observe this. When demand increased more than supply, demand also increased, supply also increased, but demand increased more than supply. When demand increases more than supply, price increases and quantity also increases. But price definitely increases. That is for sure. That is happening. Next, third scenario here, supply increases more than demand. Supply is increased more, demand also increased but less. Then price what happened? Decreased. So normal common sense, when the demand is more than supply, naturally the price will be going upwards. When the supply is more than demand, the price will be going downwards. Same way, when there is an increase in demand more than increase in supply, the price will go upwards. When there is an increase in supply more than increase in demand, the price will go downwards. Any of them can be just drawn and checked. So normal curve, simple. After that, change both. If you want more supply to happen, here give a big gap and here give a small gap. Then you will understand what happened here. What happened here? Price decreased, quantity increased. Simple. So for any change in the demand and supply, all that you need to do is put pen on pencil on paper and just test yourselves what happens when there is a change according to whatever it is given. So what can we conclude here in these two things here? When both the demand and supply increase, when both are increasing, then what happens? Definitely the equilibrium quantity increases, but the change in equilibrium price is uncertain. Why? Because it could be constant also in the scenario A, because both demand and supply are increasing in all the three cases. All the three cases, demand also increasing, supply also increasing, but price remained same in A scenario, price increased in B scenario, price decreased in third scenario. So it depends upon what, whether price changes or not. It depends upon which is more. Change in demand is more than the change in supply, then price increases. Change in supply is more than change in demand, then price decreases. If change in supply and change in demand both are same, the price will not change. But one thing for sure is what? Quantity increases guaranteed when both demand and supply increase. When demand also increases, supply also increases, quantity naturally definitely increases. Same way, opposite. When the demand and supply both decrease, then equilibrium quantity decreases, but change in the equilibrium price is uncertain. For that, we don't need a separate graph. It is only just to be looked at other side, reverse side. From D to D1, if you look at earlier, now from D1 to D, you look at it. That is a decrease in demand. So when there is a decrease in demand and a decrease in supply, guaranteed thing is what? Quantity decreases, but change in price depends upon three different scenarios. It could be same price or more price or less price. So these are the first set of changes in demand and supply that we can observe. Now, what about if demand and supply are changing in opposite direction. So far we have looked at two different layers. First level, we discussed increase in demand, increase in supply, decrease in demand, decrease in supply. There are 4 scenarios. Second level, there are 6 scenarios. Why? Wherein increase in demand and increase in supply, both are happening at the same time, but the percentage of increase in demand is more than percentage of increase in supply, or less than percentage of increase in supply, or equal. Like that, there are 3. And opposite direction also, there are 3. There are 6 scenarios there. Now, the third level of changes that happen here, what we are looking at? They are going in opposite directions. So what is the effect of the equilibrium price if the demand and supply are going in opposite directions? So here also we have 2 different scenarios. Of course, they can be multiplied with other multiple possible options also. Before going to the multiple options at the same time, let us quickly draw something to understand what happens if demand and supply go in opposite direction. Let us take, as usual, small demand and supply. Demand is increasing. Okay, demand is increasing. Supply is decreasing. Right? That's what happened. Demand increased, supply decreased. So what happened here? Here once again, price guaranteed. Price definitely increased. When the demand increased, supply decreased, price definitely increased. What happens to quantity? That we don't know. That happens because of 3 different scenarios. Whether increase in demand is more than decrease in supply, or increase in demand is equal to decrease in supply, or increase in demand is less than decrease in supply. So depending upon 3 different things, there could be different quantities, but guaranteed thing is what? When demand increases and supply decreases, price definitely rises, but we cannot be certain about the quantity. Same way, opposite also is true. When the demand decreases and supply increases, price definitely falls, but we cannot tell anything about the quantity. These are the things to be noted. Ultimately, when both are increasing or decreasing, guaranteed thing is quantity, but not price. When both are either increasing or decreasing, quantity is guaranteed. How it changes we know, but price we are uncertain. But when one is increasing and other is decreasing, whichever one is increasing but other is decreasing, then what is definite is price, quantity is uncertain. That is the conclusion of changes in demand and changes in supply. This is a typical question type of thing that can be asked in any examination. Let us quickly observe that, because this type of question can be asked in the examination. Each point represents here 1, 2, 3, 4, 5, 6, 7, 8. Each point represents one equilibrium point, because that is an intersection of one demand curve and one supply curve. And we should understand D1, D2, D3 are demand curves. S1, S2, S3 are supply curves. Let us look at some of the questions so that we can understand how to interpret this type of graphs. Point number 1. Assume X is a normal good holding everything else constant. Assume that income rises and price of a factor of production also increases. What point in the figure above is most likely to be in the new equilibrium price and quantity? So first and foremost thing, original equilibrium is 1. That is a starting point that we have to understand. This is the original equilibrium point. That is the equilibrium or intersection of S1 and D1, right? And S1 can change also, D1 can change also, increase also, decrease also. Anything is possible for that. But from this question, what happens according to the situation? Income rises, he said. When income rises, demand shifts rightwards. That means D1 becomes D2. Then price of a factor of production also increases. Price of a factor of production increases means supply decreases. That means S1 becomes S3. So S3 and D2, what is the intersection point? Answer for question number 1 should be point 2. Right? That is a point 2. That is the answer for question number 1. Second question. When we are analyzing a market for some other good Z, price of a complement good Y declines. When price of a complement good declines, demand for that complement good will increase. Along with that, demand for original commodity also increases. So demand definitely increased. Once again, D1 became D2. Then supply. At the same time, technological advance in production of goods that happened. Means supply also increased. S1 became S2. D1 became D2. S1 became S2. D2 and S2, what is the equilibrium point there for that intersection? 7. So answer for second question should be 0.7. Like this, what happens to a factor? What is the impact of a factor on the demand curve and supply curve should be identified, and intersection of those things will become a new equilibrium. Now, point number 3. Heavy rains in Maharashtra during 2005-6 caused havoc with the rice crop. What point in the above figure is most likely to be the new equilibrium price and quantity? Only one thing is mentioned here. Demand is not changed. Supply has reduced. Demand is same, D1. Supply reduced means S3 it would have become. That means new equilibrium point should be ideally 3 for the third question. That is the equilibrium point. Then fourth question. Assume that the consumers expect the prices of new cars to significantly increase next year. So what they will do now? When they expect prices of the cars will go up in next year, they buy now. That means demand increased from D1 to D2. What point in the figure above is most likely to the new equilibrium supply and quantity? Supply remains same. Only demand increased from D1 to D2. D1 increased to D2, but supply remained S1. So new point will be naturally point number 5. So each of the points has a story. Only four points are asked here. So what is point number 4 then? Point number 4, when will occur? When demand also decreased, supply also decreased. Point number 6 occurs when supply remains the same but demand decreased. Point number 9 occurs when the demand decreased but supply increased. Then point number 8 occurs when the supply increased but demand remained the same. Each point has a story, and questions will definitely come from this. If we can interpret this graph and understand changes in demand and changes in supply, how they will change the equilibrium price, that will be very crucial and scoring topic definitely when we look at such type of questions, right? And those are the things which are mentioned in the summary also. Almost all of them we have already discussed, so the summary separately is not required. So that is the pricing of commodities in a open market with an intersection of demand and supply. That is unit number 2. So unit number 1 was more about the revenue concept. Unit number 2 was mostly about price concept. Next, moving on to unit number 3. This is about different types of markets particularly. So what are the different types of market structures, particularly on the basis of competition? There are multiple types of markets possible. Perfect competition, monopoly, monopolistic competition, and oligopoly. So what is the nature of them in general can be observed from this table. In case of perfect competition, there will be large number of firms will be there, but nature of products will be homogeneous. You can just observe a small vegetable market to be a perfectly competitive market because everybody sells more or less the similar type of potatoes, tomatoes, same type of vegetables. Nothing much different will be there. And too many people will be there to sell. And price elasticity will be infinite. Why? Because if there is a small change in price also, people will shift to another supplier. They will not buy from the same person if it is available at a cheaper price at other place. So that is why price elasticity will be infinite in case of perfect competition. By the way, none of them will they will be exactly there in the real life. That is a big mistake sometimes people do and students mostly do. They try to relate everything to one of these names only. It is not possible in real life to exactly put anything example into perfect competition, monopoly, etc. Why? Because nothing like that exists in reality exactly in the same form. It will be a mix of everything. Something can be a mix of perfect competition plus monopolistic competition. Something could be a mix of monopoly plus perfect competition a little bit. So that can be oligopoly. So a lot of mixes will happen in real life. These are theoretical, conceptual, broad classifications only. That limitation we have to keep in mind. And in case of perfect competition, the seller is a price taker. He is not a price maker. So the degree of control over the price for a perfectly competitive firm will be none. Nothing will be there. So these are the features of perfect competition. Then coming to monopoly, number of firms will be 1. Is it possible? Practically not possible. So only theoretically, in case of monopoly, only one firm will be operating. And the nature of product will be unique product without any close substitute. There will not be any substitute in the near competition at all. Completely unique product. So there is nobody to offer the same product also in the market. Like that it will be in case of monopoly. And price elasticity will be small because people do not have a choice. They have to go for purchasing from the monopolist only, irrespective of increasing price or not. And degree of control over the price by the monopolist is very considerable naturally. Why? Because he is the price maker, whereas perfectly competitive firm is a price taker. Monopolist is a price maker. That is the difference. And coming to the imperfect competition, they can be classified into two categories further: monopolistic competition and oligopoly. First, monopolistic competition will have a large number of firms, and the products are differentiated products. In case of monopolistic competition, there will be product differentiation a little bit. Let us say soaps are all there. They are differentiated. All of them will ultimately be used for the same purpose, but some will have neem flavor, some will have sandalwood flavor, some will say I have aloe vera, somebody will say I have something like all herbs together. A lot of different types of products are there. Somebody will say milk cream is there in that, somebody will say badam is there in that. Differentiation is there a little bit. Large number of firms are there. Competition is also there. That's a kind of monopolistic competition. And most importantly here, the price elasticity is very large. Okay, people definitely like to have some kind of a product with a brand loyalty, but that does not mean they will buy a product at whatever price they want. That is offered. Definitely there will be price elasticity, which is huge, large. Not as much as perfect competition, not as small as monopoly, somewhere in between that. Then, in the case of monopolistic competition, there will be some bit of control over the price for the sellers. Some control will be there, not much. Once again, not much as monopoly, not less as less as perfect competition also. Somewhere in between these two it is. That is why it is called monopolistic competition. And oligopoly is such a type of situation where very few firms will be there, and they will more or less have homogeneous product. Very rarely they will have differentiated product also, but mostly they will have homogeneous products only, and their price elasticity will be small, and control over the price will be only little bit. Once again, oligopoly broadly just can be understood in a situation of where very small number of firms are dominating the market. Homogeneous products mostly they are offered. Let us say something like Coca-Cola, Pepsi. Duopoly, where only two firms are dominating the entire market. That is a kind of oligopoly. Duopoly is also a kind of oligopoly wherein more or less homogeneous products are offered by very few firms like that. And this oligopoly can be observed in many industries also. Mostly, even in the accounting sector, big four, when we say, there are very few firms which dominate the market. There are so many other firms, but they'll have very almost negligible market share. Very few firms dominate the market. We can see that in the film industry also. We can see that in the oil sector also. In the entire world, mostly the oil and gas sector is dominated by 4 or 5 firms. Mostly the entire world's entertainment industry and news media is dominated by 4 or 5 firms. Like that, lot of times it so happens few firms dominate the entire market. That is called as oligopoly. Then the same things are explained here in a little bit detailed manner, but most importantly than just knowing the nature of them. I know once again, a lot of times people are interested in knowing what is soap market, what is toothpaste market, what is shampoo market, what is shoes market. Nobody should be interested in that at the learning level. Once you pass the foundation, you have a lot of time. Then you think about all those things with your own brain, and you check the other people also, so that they can have their own opinion. But that is not going to add over any knowledge to us by classifying one particular market into one name. That is not some great job we are doing if we are doing that. Main thing is for us to understand the nature of each of these markets, and more than just the nature, it is to understand the technical aspects of each of these markets. What happens in case of a perfect competition? How the perfectly competitive firms, different areas will be like that. That is the various things that we have to identify. So this is how the firm under perfect competition will be. Any perfectly competitive firm will have, first of all, normally like any other firm, demand curve and supply curve will be there, and equilibrium price is there. There is nothing different in that. And where the perfectly competitive firm is there, this is the main point that we should identify. Average revenue is equal to the marginal revenue. Average revenue is equal to the marginal revenue. Why? Because that is the demand curve. When in case of a perfectly competitive market, first thing foremost we have to understand is the elasticity of demand in a perfectly competitive market is infinity. When elasticity of demand is infinity, that means the demand curve will be parallel to x-axis. All these things we should already know, which we discussed in second chapter. That is the demand curve. That is the AR and MR also for the purpose of perfectly competitive market. That is a point to be noted. And where the equilibrium will happen, that we already discussed just now, where a particular firm will maximize its revenue, where the marginal cost is equal to marginal revenue. And a very important point, where the marginal cost line cuts the marginal revenue line from the below. That is what we have to focus on. Okay, other things are all there. When it is called a perfectly competitive market, oh, so many features are there. These are all descriptive things, definitely important and general understanding purposes. Large number of buyers and sellers will be there, homogeneous products will be there, free entry and exit, perfect mobility of factors of production, perfect knowledge about the market conditions, almost insignificant transaction costs, no government interference, absence of collusion. All these are the features of perfect competition. Well and good. So simple. But technical point is what? Technical point here is a firm is in equilibrium in a perfectly competitive market anytime, not only perfect competition, actually anytime, when its MC is equal to MR, marginal cost is equal to marginal revenue, and MC curve cuts the MR curve from the below. So now look at this particular scenario. Here also MC is equal to MR. Here also MC is equal to MR. So can we say T as an equilibrium point or T as a point where the firm will maximize revenue? Should the firm produce Q1? No, that is wrong. Why? Because MC curve here is cutting the MR curve from the above, where it is cutting from the below at R point. So what is the quantity that a firm should produce and sell in order to maximize its profits under the perfect competition in this example is Q2. Why is that? Because MC curve has cut the MR curve at R point from the below. That is the quantity which it should produce and sell, not T. Because T was the point which emerged because MC was cutting the MR from the above. That is not what we are asking or looking for. We are looking for where MC curve cuts the MR curve from the below. That is a technical point to be noted. And why MR curve is equivalent to AR here? Why the demand curve or MR curve or AR curve is parallel to x-axis? Because the elasticity of demand is infinite. And we know that what is the marginal revenue, average revenue relationship also we know that when there is a marginal revenue is equal to average revenue into E minus 1 by E, when E itself is infinite, then there is no point of E minus 1 by E, that is not definable. That means AR is equal to MR. So AR is equal to MR is equal to demand curve. That is parallel to x-axis in case of a perfectly competitive firm. We know from the cost formula and cost function that we learned earlier in chapter 3, where marginal cost curve will be just like this anytime. And where it is cutting the marginal revenue curve from the below, that is the point or optimum level of production for a perfectly competitive firm. That is the crucial point here to be noted. Now, in the short run, a perfectly competitive firm may be earning normal profit, supernormal profit, or making losses at the equilibrium price. How it will make normal profit, supernormal profit, or even it can have losses. Let us look at that. But before that, there is one more small point also to be noted. This can be a question also. Normally, when we say the marginal cost curve, which is like this, like a Nike curve, marginal cost curve, that is the supply curve for a price-taking firm. What is a price-taking firm? That is a perfectly competitive firm. For a perfectly competitive firm, marginal cost curve and supply curve both are one and the same. This is the proof. Marginal cost curve, supply curve, both are looking like same. So that is one more general point. That is a question by itself. Now let us look at profits. How the firms can make, which are perfectly competitive firms, which can make normal profits, supernormal profits, and losses. First of all, what is normal profit? Normal profit is something where economic profits are zero. Economic profits are zero. But accounting profits are positive. Why is that? For this, we need to know the difference between accounting cost and economic cost. Accounting cost is the explicit cost. Economic cost is accounting cost plus implicit cost also. That means what? Accounting cost will always be less than the economic cost. That means what? Naturally, the economic profit will be always less than the accounting profit. All these things are linked with each other. Now, when economic profit is zero means what? the firm is able to cover its explicit costs also, implicit costs also it is able to cover. That means it is economic profit zero. These are called normal profits. Normal which profits? Accounting profits. Then when economic profit itself is greater than zero, of course, accounting profit will be definitely greater than zero. When economic profit is zero itself, accounting profit is positive. When economic profit itself is positive, then accounting profit is bound to be positive. Then, if at all economic profit is greater than zero, means positive, that is called as supernormal profits, because a firm is able to get over and above its explicit costs as well as implicit costs put together. That is called as supernormal profits. In case a firm is able to and it's cover its explicit costs also, implicit costs also, and earn anything above explicit and implicit costs also. That is called as economic profits positive. That is supernormal profits. When economic profit is zero, it is called normal profits. When economic profits is greater than zero, it is called supernormal profits. Naturally, when economic profit is less than zero, it is losses. So now the point is simple. When the perfectly competitive firm will get each of these three things. First thing first, let us look at supernormal profits. If you observe the graphs, it will be easier. And we know very well the price or marginal revenue or average revenue will be parallel to x-axis. That is always the same. And we know where the marginal cost curve cuts this line, that is the equilibrium point of quantity. That is where we are operating. That is also known to us already. Nothing new. But only point is whether it is making profit or loss, how would I know? You will know when the average total cost line is going below the average revenue or above the average revenue. Simple. When will you make profit? When average revenue is more than average total cost. That is profit, right? Or other side, if you can say average total cost is less than average revenue, both are same. We are not writing anything different. When this is happening, here this is happening because average total cost here is below the average revenue. Average total cost has gone below the average revenue at point of time. So this entire area represents profit. When is that? Average total cost line is going, this is average total cost. If you say if it is going below the average revenue line, which is the horizontal line, then there is a supernormal profit. Then when there will be normal profit, that means only when it touches, just touches average total cost, touches the average revenue. That is what happening here exactly. If you see, average total cost is just touching the average revenue, nothing more, nothing below. So in the first case where the average total cost is below the average revenue, naturally there are profits. We call them supernormal profits. Here, second case where average total cost is touching the average revenue, we call it normal profits. That is zero economic profits. Now look at the third scenario where the average total cost is going above the average revenue. It is not even touching. There is a lot of distance between average revenue and average total cost. Simple logic. When cost is more than revenue, that will result in loss. That is loss. So identifying whether it is a supernormal profit, normal profit, or loss is not a big deal. And that happens in any case of type of market. Only thing is the shape of the revenue curve may change, but the logics what we are looking at will be remaining same. Marginal cost curve should cut the marginal revenue curve from the below, and when the average total cost is below the average revenue, there will be supernormal profits. When the average total cost is equal to average revenue, there will be normal profits. When the average total cost is above the average revenue, that will be losses. Any of them can happen for a competitive firm. This is about the competitive firm or perfectly competitive market. One type of market, if you understand, remaining things will also be more or less the same. Once again, concept will be same. The shape of the curves only will differ. Now, for a perfectly competitive firm, in the long term, what happens? In the long run, the super normal profits or losses get wiped away, because when a particular firm is earning supernormal profits, a lot of people will be very much interested and greedy. They will join the market. And in a perfectly competitive market, we know that anybody can enter and exit. So many people will come, and that will reduce the existing profits of the firm, which means the supernormal profits will be wiped away in the long run. And all the firms in the industry will earn only normal profits. That is what is shown here. What happens here in the long run? Exactly, everything will be just touching the average revenue and marginal revenue, nothing will go below. So the long run average cost curve is tangential to the average revenue curve in the long run, which means all the firms will be able to make only normal profits, not supernormal profits. That is the point. And in the long run, naturally, in perfect competition, the market mechanism leads to an optimal allocation of resources. Okay, naturally, that happens in any market for that matter. In perfect competition, definitely it happens. Is a generic statement. So these are the various aspects related to perfect competition. Once again, features of perfect competition is one most important thing from examination point of view and questions point of view. Technical things are about what about this marginal cost curve? Where is it cutting the marginal revenue curve? Where is the average total cost line cutting the average revenue line, or is it cutting or not? If it is cutting from the below, then there is supernormal profit. If it is just tangential, then there is normal profits. If it is not at all touching AR also, then it is losses. These are the different types of situations in the long run. Whereas for a competitive industry, there will not be supernormal profits. There will be only normal profits. You can observe here, from that there is an equation. That's a beautiful thing. Where in the long run, what happens? Short run marginal cost is equal to short run average cost is equal to long run marginal cost is equal to long run average cost. All have become equal in the long run. Everything has culminated at one point, and that is where exactly is this. Everything is equal in the long run for perfectly competitive firm, which is a theoretical thing. Really, no such situation exists. Now coming to the monopoly, it is an extreme form of imperfect competition with a single seller of a product, single seller only, which has no close substitute. Already we have looked at the features of monopoly. And since the monopolist firm is the only producer, its demand curve is identical to the market demand curve for the product. So demand curve for monopoly will be like a market demand curve. How it will be for any market demand curve, how it will be, same way it will be here also. So what is the demand curve here? That will be going downwards. That is this. Demand curve is represented by AR. That is price. No? That is the relationship between the price and quantity demanded. So that is identical to the market demand curve for the product. And since monopoly firm has market power, it has the ability to charge a price over and above the marginal cost and earns a positive economic profit. Possible for a monopoly. Why? Because it has power on the market. It can earn a positive economic profit. And of course, certain futuristic things like why monopoly can occur, what is the cause of monopoly, it could be barriers to entry, and because of that other firms cannot enter the market. However, in the long run, the normal profit will be continued once again because of entry being restricted. In the long run, a normal the perfectly competitive firm cannot earn supernormal profits. It can earn only normal profits. But in case of monopoly, it can earn supernormal profits also in the long run because it has power over the market. That is the difference between perfect competition and monopoly. But if you look at various other things in monopoly, all other things are the same. If you look at this, the difference of monopoly and perfect competition comes only with the average revenue line. In case of perfect competition, it was like this. In case of monopoly, it is like this. Same with marginal revenue also. Now it has gone down like this. In case of perfect competition, our marginal revenue and the average revenue both are same. That is different. Average revenue or marginal revenue both are same in case of perfect competition. But in case of monopoly, average revenue is different, marginal revenue is different. Now other things remain same. Average total cost, look at in this case. First point first, what is a quantity which is supposed to be manufactured where the marginal cost line touches the marginal revenue line. So that means this is the quantity that should be manufactured. Then average total cost line, is it above the average revenue or below the average revenue? It is below the average revenue up to here. So this is the profit. Same way, if average total cost is above the average revenue, which is in this case, average total cost is not touching the average revenue, it is above the average revenue, then it results in losses. Of course, generally the touching point and all will not happen for monopoly. In the long run, definitely there will be profit for a monopoly because average total cost will be below the average revenue line. So these are the technical points to be noted in case of any type of market, whether it is perfectly competitive market or monopolistic market. What are the points there to be noted are same. Marginal cost line should cut the marginal revenue line from the below, and depending upon where the average total cost is compared with average revenue, whether it is making profits, normal profits or supernormal profits, or losses will be there. In general, monopoly can have supernormal profits also and losses also in the short run, in the long run, but monopoly generally gets supernormal profits only. Whereas in case of competitive firms, in the short run, they can have normal profits, supernormal profits, or losses. But in the long run, they will only earn normal profits. They cannot earn supernormal profits. That is the difference between perfectly competitive market and a monopoly market. And another very important characteristic of the monopoly is a price discrimination. Price discrimination means a monopolist can charge different prices from different customers. Price discrimination is a very important feature of monopoly. That can be just observed from this graph also. Look at these two different markets. Let us say this is a submarket A, this is a submarket B. Total, we don't care. Here, what is the nature of the elasticity of demand in the market A? We can observe that elasticity of demand is less because the curve itself is little slant. In submarket B, the elasticity of demand is little bit more. So what happens is, where the elasticity of demand or price elasticity basically is less, the monopolist can charge a high price because people don't care. They are okay with higher prices. The elasticity of demand or price elasticity is lesser in submarket A, charge more price there. Where the elasticity of demand or price elasticity is more, you charge a less price. So compared to P1, definitely P2 is lesser. So charge a higher price in submarket A, lower price in submarket B is the strategy that monopolist observes. That is called as price discrimination, which a monopolist follow. Where he will charge a higher price, where the demand is less elastic naturally, and where he will charge a lower price, where the demand is more elastic. That's it. And there are different degrees of price discrimination. That also is important question. In case of first degree price discrimination, he will separate the market into each individual consumer. Let us say if we go to a doctor, he can charge more price from one patient, more fees from one patient, and less fees from another patient. That is an example of first degree discrimination. Second degree discrimination will be for different quantities of the goods which are sold. For example, a wholesaler will purchase huge quantities and he will get a lesser price. Retailer will purchase lesser quantities and he will have to pay more price. That is second degree of discrimination on the basis of quantities. First degree is individual discrimination. Second degree is quantity based discrimination. Third basis is a location or a customer segment based discrimination. So for a particular location, the higher price is charged, and for another location, lower price is charged. You take iPhone, for example, Apple company charges lower prices in USA and even in China, for example, but it charges high prices in India and Gulf countries because of its price discrimination policy, which it can implement. It has the capacity to do that, so it is doing. It has some kind of monopolistic power over the market, so it is implementing price discrimination. That is a third degree price discrimination. And in the absence of competition, the monopolist need not produce at the optimal level because that is his choice. He need not produce at optimal level. Once again, if you look at the monopolist's point here, where he will sell less quantity here in the submarket, more quantity in the submarket B. Quantity what he is selling is less in submarket A, and he is selling at a high price, and selling more quantity in submarket B, selling at a low price. He doesn't have to sell optimum quantities. That is his choice. That is the power of monopolist, we can say. And since monopolies are exploitative, generally undesirable outcomes will come in the monopolies. And of course, governments will try to regulate and prevent the formation of monopolies through different legislations. Like in India, we have Competition Act. And in America, there is antitrust laws, which will be there to try and regulate monopolies and try to not form cartels wherein they can dominate the market. So competition to be encouraged is one of the objectives of many governments and economies that they will try. Of course, in real life, there is no monopoly. Generally, that is not possible unless there is a government which decides that I will only supply this service. Like in India, railways is monopoly from Indian Railways. Unless government decides that, generally in open markets, we cannot see monopoly because they are either regulated or prohibited altogether. That is the nature of monopoly. And coming to the imperfectly competitive markets, one of them is monopolistic competition, where Many producers produce goods which are close substitutes of one another. As we discussed, just like soaps and all, they are close substitutes of one another. Though there is a differentiation, they are close substitutes only. But many producers are there who produce that. That is a monopolistic competition. What are the features of this monopolistic competition? Again, these are all very generic things. Existence of large number of firms, product differentiation does exist. Competition here is non-price competition. That is very important point. Non-price competition. Competition is not on the basis of price. They will say this is a special thing. Our doctors have invented it. Our doctors have told that using this is fantastic. It is good for health. Like that they will tell. It's not about price only always. So mostly it is a non-price competition. High selling costs because they need a lot of advertising. Freedom of entry and exit of the firms also happens in monopolistic competition. And in monopolistic competition, the features of monopoly and perfect competition are partially present. So it is a hybrid thing, somewhere between monopoly and perfect competition. And a demand curve is highly elastic and a firm enjoys some control over the price. There is high elasticity of demand. Once again, if suddenly the price of a neem-based soap increases, we can shift it to another brand of neem-based soap also. Maybe suddenly we can shift it to a lemon-based soap or aloe vera-based soap. It is not going to make big difference. So price elasticity is relatively high here. And once again, the monopolistic competition firms do not necessarily operate at optimum size. That is why there exists always excess capacity with each firm. These are the features of monopolistic competition. In general, as far as the technical things are concerned, whatever we discussed about monopoly, same things will apply to monopolistic competition also, only except the price discrimination. Other than that, all other graphs remain the same for monopolistic competition also. Then oligopoly is something which is a kind of offshoot from monopolistic competition only. It is a competition among the few. Very few big firms produce and compete in this market. That is called oligopoly. So here there can be different types of oligopoly. We don't need to really get into each and every type of oligopoly because a lot of similarities are there in that. There can be pure and differentiated oligopoly. There can be open and closed oligopoly, collusive oligopoly, competitive, partial, full, syndicated, organized, like that. So many oligopolies are there. Some of them are actually illegal also. So we don't need to really get into each and every type of oligopoly. But simple characteristic of oligopoly is what? There is a strategic interdependence among the firms. Though Pepsi and Coca-Cola compete with each other, there is still a strategic interdependence. Suddenly, if Pepsi increases the price, then Coca-Cola will get sudden advantage. So Pepsi will not do that. Or suddenly, if one company decreases the price, others also will decrease automatically. So there is an interdependence at a strategic level among the organizers or organizations. That is what is one of the primary characteristics of oligopoly. Advertising becomes very important in oligopoly. Selling costs are high and group behavior happens in oligopoly because they will have cartels formed, particularly in case of a syndicated and organized oligopoly, though they are illegal. So different types of oligopoly settings give rise to different optimal strategies and diverse outcomes. We cannot exactly tell this is perfectly something which is oligopoly, but the oligopoly is something like a miniature version of monopolistic competition, we can say. But here, price leadership can be by a dominant firm and low-cost firm, or it can be a barometric price leadership on the basis of having a overall bar and overall limit, and within that, whoever is there, they will have a leadership. Beyond that price, nobody will be able to compete in the market. So that, like that, price leadership can happen, and sometimes they can collude with each other, coordinate with each other to form a cartel. Again, it is illegal. But what is the main point related to oligopoly as far as the technical aspects of graph is concerned? This oligopoly will have a kinked demand curve. That is the nature of it. The demand curve is kinked. There is a bend there. That is a kinked demand curve, we can say. So that we can understand, when the demand curve is like this, that means the elasticity of demand is too heavy. Then once it becomes like this, that means the elasticity of demand is lesser. Earlier the price elasticity was high. Later the price elasticity has become lesser. That's what happens in case of oligopoly. That is why it is called as a kinked demand curve. So the price will be kept unchanged for a long time due to the fear of retaliation, and then price tends to be sticky and inflexible later. Again, Coca-Cola, Pepsi prices are the classic examples. For decades together, for almost many years, the price of them did not change much. changed, but very less. Why? Because they know that product is a very price elastic product. After that, the prices more or less remain constant. Though there is a less price elasticity of demand, they become sticky. There will not be too much of changes in price for such kind of situations. Classic example of that can be the Coca-Cola Pepsi competition, and their pricing models also are an example of oligopoly in general. Another important market forms are duopoly. Duopoly means oligopoly with only two. Coca-Cola Pepsi is again the classic example of duopoly. Monopsony. See, poly is about sellers, Sony is about buyers. Monopsony means there is only one buyer. Government is the only buyer for many firms actually in India. For example, there is a company which is manufacturing defense equipments in India. Who is the buyer for them? Only government. They cannot sell missiles and all to everybody. So only one buyer is there, means that is monopsony. Oligopsony means, once again, there will be few buyers who are dominant buyers. Bilateral monopoly means they are having two types of monopoly, which means monopoly is also there, monopsony is also there. Both are there. One buyer, one seller. Only one buyer, one seller. That is bilateral monopoly. These are different types of possible markets also. But at a broader level, the classification is simple. That is mostly in the form of monopoly, perfect competition, monopolistic competition, and the oligopoly, right? These are the various concepts first. Now let us quickly go through some of the MCQs in relation to this chapter. Once again, to save the time, I have already marked the answers so that we can understand the reasons for the answers and move on quickly. Question number 1. In the table below, what will be the equilibrium market price? Simple. Where the demand is equal to the supply, that is the equilibrium market price. Where the demand was equal to supply, demand was also 700, supply was also 700. At what point? Where was that happening? It was happening here. So what is the equilibrium price? 4 rupees. So the correct answer is C, 4 rupees for the first question. Question number 2. Assume that when price is 20 rupees, the quantity demanded is 9 units. And when price is 19 rupees, quantity demanded is 10 units. Based on this information, what is the marginal revenue resulting from an increase in output from 9 units to 10 units? Marginal revenue is asking. For that, we need to first find out total revenue. When price is 20, quantity demanded 9 units means what is the total revenue? Price into quantity. 20 into 9, that is 180 rupees. When price is 19, quantity demanded is 10 units. That means 19 into 10, 190 is the total revenue. So naturally, what is the marginal revenue? Additional revenue generated by selling one more unit is how much? 10 rupees. So correct answer is C. Then question number 3. Assume that when the price is 20 rupees, quantity demanded is 15 units. And when price is 18 rupees, the quantity demanded is 16 units. Once again, same thing. Need to do the calculation. When the price is 20, quantity demanded 15 units means total revenue can be 300. That is okay. But when the price became 18, quantity demanded is 16. 18 into 16, it is 288. It has reduced actually the total revenue. Based on this information, what is the marginal revenue resulting from an increase of output from 15 to 16 units? Minus 12 actually, but still, since there is no minus, C is the only thing. He said marginal revenue. He never said plus or minus. So marginal revenue is 12, right? When it is 20 rupees, 15 units means 300 is the total revenue. When the price is 18 rupees, quantity demanded is 16 units, 288, correct. Minus 12 is the marginal revenue. If the 4 options had minus 12, that will be the correct answer. Since it doesn't have, forget about sign, only look at the absolute number. That is C, correct answer for question number 3, 12 rupees. Question number 4. Suppose a firm is producing a level of output such that marginal revenue is more than the marginal cost. Good, no? The firm should increase the output. Exactly, that is the best thing. Where the marginal revenue is more than marginal cost, that is a good thing. If the marginal revenue is equal to marginal cost, that is also a good thing. But if the marginal revenue is less than marginal cost, that is not a good thing. Marginal revenue more than marginal cost, fantastic. The firm should increase the output. So D, Delhi is the correct answer for question number 4. Then, 5th question asks about what is marginal revenue. That is the change in P multiplied with Q. P multiplied with Q is total revenue due to a 1 unit change in output. That is the definition of marginal revenue. So C is the correct answer for question number 5. Then look at question number 6. These type of questions can be expected. Suppose the sole proprietorship is earning a total revenue of 1 lakh and incurring an explicit cost of 75,000. That means, first of all, how much is the accounting profit? That we should first find out just for understanding. 25,000 rupees is the accounting profit because revenues 1 lakh, explicit cost 75,000. The owner could work for another company and 30,000 a year, but that is not working. That is an opportunity cost. That means if that is also taken into consideration, what will be the economic profit? Because here economic cost is not 75,000. Economic cost is 75 plus 30, 1,05,000. So what is the economic loss? Actually 5,000. So this is a classic example where we can understand everything. Revenue is common, that is 1 lakh. When accounting cost or explicit cost is 75,000 and opportunity cost of 30,000 is there, how much is economic cost if the question is 1,05,000? How much is accounting profit if the question is 25,000? How much is economic loss? 5,000 loss. And difference between accounting profit and economic profit is naturally the implicit cost. Same way the difference between economic cost and accounting cost also will be the implicit cost or opportunity cost. In this case, that is 30,000 rupees. So what is the answer here is the firm is incurring economic loss. How much is not giving, but yes, that is the answer. If at all this options has firm incurring an economic loss of 5,000, then that would be correct answer, but it is not there. So it is A is the correct answer. Others are all wrong answers. That was question number 6. Then question number 7. Which of the following is not an essential condition of pure competition? Absence of transport cost, nobody said. In pure competition or perfect competition, there will be large number of buyers and sellers. There will be homogeneous products. There will be freedom of entry. But nobody said transport cost will be not there. That is illogical. So it is not a condition of pure competition. So question number 7, correct answer is D, Delhi. Then 8th question, direct question. What is the shape of the demand curve faced by the firm under perfect competition? Horizontal. A is the correct answer, direct question. Then question number 9. What is the first order condition for profit of a firm to be maximum? That is what we have been looking at. Where the marginal cost should be equal to marginal revenue, where the marginal cost line cuts the marginal revenue line from the below. Cuts means what? Below, above, secondary. But cuts means what? They should be both equal. That is the first condition. So MC should be equal to MR. That is the first condition. So answer is B, Bengaluru for question number 9. Then question number 10. Which of the following is not a characteristic of a price taker? First of all, who is a price taker? Price taker is that one who is in perfect competition. So what is not a characteristic of price taker? Negatively sloped demand curve is not a characteristic of price taker, because for a perfectly competitive firm, demand curve will not be like this, which is normally going to happen. But for a perfectly competitive firm, demand curve is going to be horizontal. Other conditions are all definitely the characteristics of price taker. Total revenue is equal to P into Q. Average revenue is equal to price. Marginal revenue is also equal to price. For a perfectly competitive firm, this is important point always to be remembered. Average revenue is equal to marginal revenue is equal to price. And that price layer is horizontal. That is about perfectly competitive firm. So negatively sloped demand curve is not a characteristic of price taker. C is the correct answer for question number 10. Then question number 11, which of the following statements is false? Here it says, D says, accounting profit is equal to total revenue less implicit cost. No, that is not accounting profit. Definitely not. Actually, it is nothing. Total revenue less implicit cost will not give us anything. It is neither accounting profit nor economic profit. Total revenue minus explicit cost minus implicit cost will give economic profit. Total revenue minus explicit cost gives accounting profit. Here it says total revenue minus implicit cost is accounting profit. That is not a correct statement. That is what we want. So the correct answer is D, Delhi for question number 11. Then question number 12. With a given supply curve, see, these are the things I was talking about. Supply curve given means constant. Given means always it is fixed. Supply curve is fixed. Decrease in demand, what happens? Don't even try to look at the answers. Simply all that we need to do is first draw some this X. Okay, this is the original equilibrium. Now what he says, then look at the question. Supply curve is standard, demand decreases, he says. Okay, when the demand decreases, what happens to the demand curve? It goes down. It goes down means what happened? What happened? There is a decrease in price also, and there is a decrease in quantity also. Where is that answer? Check that. C is the answer. Overall decrease in price and decrease in equilibrium quantity. Direct. If you keep on looking at ABCD answers and try to find out which is the correct answer, our brain will just get confused and it will get stuck there. That is called a net, a jal jaisa. It will be there only. It will never come out of that. Dangerous situation. How can you come out of that? Don't look at answers. First, you have the answer with a graph on a small paper, enough. That will give us a correct answer. Question number 12, answer is C. Then question number 13, it is assumed in the economic theory that the ultimate goal of the firm is to maximize profit regardless of the size or type of the business organization. Of course, that is a basic assumption under economics. So correct answer is B, Bangalore. Then question number 14, assume that the consumer's incomes and the number of sellers, in the market for a good year both decrease. Consumer's income decrease means demand decreases, and number of sellers decrease means supply also decreases. Both decrease. When demand also decreases, supply also decreases, we can conclude with certainty what? When both decrease, quantity will decrease, but we cannot tell price will decrease or increase or change, does not change. There are three possibilities for that. So with certainty, what we can say, when both are decreasing, only we can say quantity will decrease. So correct answer is D, Delhi. That is question number 14. Then question number 15 also similar. If supply increases in a greater proportion than demand, supply increases in a greater proportion than demand. When the supply increases than demand, definitely the price will decrease. That is for sure. So new equilibrium price will be lower than the original price, and the new equilibrium quantity will be higher. Why? Because both are increasing. When both are increasing, definitely one thing for sure, guaranteed, we can say quantity is going to increase. Only point is price we have to check. For that, you can draw a graph also. You can just think about logically also. When the increase in supply is more than increase in demand, when the increase in supply is more than increase in demand, the price should decrease. So quantity increases guarantee, price will decrease in this particular scenario. So that is contained in option D. So option D, Delhi, is the correct answer for question number 15. Question number 16. Assume that in the market for goods Z, there is a simultaneous increase in demand and quantity supplied. So when there is a demand and supply, both are increasing, definitely there is an increase in the quantity, but we cannot talk about the equilibrium price. So increase in the equilibrium quantity happened, but uncertain effect on equilibrium price happens. Why? Because we don't know increase in demand is more than increase in supply, or increase in demand is equal to increase in supply, or increase in demand is less than increase in supply. Without knowing that, we cannot talk about price. But one thing for sure, when demand supply both increased, quantity though definitely is going to increase. So C is the correct answer for question number 16. Lot of questions definitely can be expected from this. I told you already, increase in demand supply type of situations are very important aspects from the examination point of view. Now again same. Question number 17. Suppose the technology for producing personal computer improves. That means supply increases. At the same time, individuals discover new uses for personal computers so that there is a greater utilization of personal computers. That means demands also increases. When people have multiple uses, they buy more. Which of the following will happen to equilibrium price and equilibrium quantity? Supply increases, demand increases. Once again, same. Quantity will increase. Price cannot be determined. So C is the correct answer. Then question number 18. Which of the following is not a condition for perfect competition? Perfect competition, informative advertising to ensure customers have good information will not happen in perfect competition. No normal roadside vegetable vendor is going to give any advertising. Advertising is not going to be a big useful tool in perfect competition, not required. In monopoly, at least some advertisement will happen to inform the people that we are there. Though we are monopoly, still we can give some advertisement to the people so that we are there. This is existing brand. Informative advertisement is there. Monopolistic competition and oligopoly, heavy advertisement will be given. It's not just only going to be informative. Sometimes it is going to be highly competitive, and sometimes even it will be very encroaching into the others' territory also. Sometimes insulting others also. So a lot of bad advertising can happen in other things. But monopolistic competition and oligopoly are different. Monopoly does not require such kind of things. But in perfect competition, advertisement itself is not at all a condition. So C is the correct answer for question number 18. Question number 19 asks, which of the following is not a characteristic of a perfectly competitive market? Once again, same question actually. Firms face downward sloping demand curves. No, no, no. Firms do not face downward sloping demand curves. In perfectly competitive market, they will have a horizontal demand curve. C is not a characteristic of perfectly competitive market. Hence, that is the correct answer. That is question number 19. Answer C. Question number 20. Which of the following is not a characteristic of monopolistic competition? A homogeneous product will not be a characteristic of monopolistic competition because there will be product differentiation. Both are opposite. B and D are opposite. One of them only can be its characteristics. Product differentiation is a characteristic of monopolistic competition. Homogeneous products is not a characteristic of monopolistic competition. It is a characteristic of perfect competition. Same kind of product. Whichever vegetable vendor you go, more or less the same kind of vegetables will be there. Little bit difference in quality will be there, but more or less same product. Nothing special will be there in any one vendor when compared with another vendor. So that is what is the nature of a monopolistic competition, where there will be product differentiation but not homogeneous products. Hence, question number 20 answer is D, Delhi. Then question number 21, monopoly may arise in a product market because of what? What is the reason he is saying? Maybe all the reasons are there, like important resource for production of a commodity is owned by a single firm. Maybe the government has given a patent right to produce a commodity, or economies of scale are so high that single producer manufacturing done by a single producer is more efficient. Any of the reasons can create a monopoly. So D, Delhi is the correct answer. All of the above can cause a monopoly to occur in real life. But once again, reality is different. Theoretical conceptual aspects are different. That classification in the brain, if we do, we'll have a lot of clarity. If we want to mess it up, everything, whatever we are looking from a theoretical point of view, conceptual point of view, I want to apply and see in the real life, that creates a lot of confusion. Confusion only comes when we really try to apply everything. Certain things, yes. For examples, understanding, yes. Not for everything. That is not possible, and that is not the way the theories work. Theories work only from theoretical point of view. That will not work in reality all the times. But still, whatever the theories say, whatever the subject says, to that extent, conceptually, if you understand, then there will be clarity. Clarity and confusion are very simple things. Differentiation is in our hands. That is only in the approach, not in the capacity of a person. So here, each question and each topic has its own important aspects. If we observe them carefully, we will be able to answer questions well and get good scores in this paper, for that matter, any paper. Now moving on to question number 22, oligopolistic industries are characterized by, oligopoly itself means that a few dominant firms and substantial barriers to entry. That is there. So oligopolistic industries are characterized by that, a few dominant firms. A is the correct answer for 22nd question. Then 23rd question is price-taking firms. Taking firms means perfectly competitive firms are said to be small relative to the market. Are they not? Yes. Because the firms are very small, means large number of firms will be there, and the market is bigger than the individual players. Why is that? Since individual firm is unable to affect the market price through its output decisions. That is why they are price takers, not price makers. That is a perfectly competitive firm. Hence, we call that a firm is smaller than market in case of a perfect competition, since it is a price taker. Once again, 24th question also is about that. For a price-taking firm, marginal revenue is equal to price. That is what we know that. Marginal revenue, average revenue, both are equal. For which type of firm? Only for price-taking firm, only for perfect competition. In other cases, it is different. For a monopoly, marginal average revenue will be more than the marginal revenue. So other firms have differences in average revenue and marginal revenue, whereas for a perfectly competitive firm, both will be same. And that will be equal to the demand curve also, which is horizontal to the x-axis. Then question number 25, monopolistic competition differs from perfect competition primarily because of what? Monopolistic competition and perfect competition, what is the difference? Monopolistic competition, there is a differentiation in the products, whereas in perfect competition, the product differentiation does not exist. The products are homogeneous. That is the difference. So the answer is A for question number 25. Then question number 26. The long run equilibrium outcomes in monopolistic competition and perfect competition are similar. Perfect competition and monopolistic competition, long run outcomes are similar. Because in both market structures, the firms can only earn a normal profit. In both cases, the firms cannot earn a supernormal profit. Long run outcomes are similar in both the cases. Only which type of firms can earn supernormal profits? Only monopolies can earn supernormal profits in the long run, whereas perfect competition or monopolistic competition can earn only normal profits. That is why question number 26, the answer is C. Then question number 27, which of the following is the distinguishing characteristic of oligopoly? So one of the things is interdependence among the other firms. That is one of the distinguishing characteristics of oligopoly. Standardized product and all will not be there. Actually, product differentiation will not be that much. And downward sloping demand curve will be there for anybody. There is no specialty in oligopoly. What is the specialty of oligopoly? Interdependence among the firms. That is a specialty or a distinguishing characteristic. So C is the correct answer for question number 27. Then question number 28. In which form of the market structure is the degree of control over the price of its product by a firm is very large? Naturally, monopoly. Monopolist can exert more control and influence on the price than others. So A is the correct answer for question number 28. Average revenue curve can also be known as demand curve. Direct question. So 29th question answer is Bengaluru. Average revenue curve, demand curve, both are same. Then question number 30. Under which of the following forms of market structure the firm have no control over its price? Naturally, perfect competition. In case of perfect competition, price taker, the firm will be, it has no control over the price. So correct answer will be D, Delhi. Then question number 31 asks about discriminating monopoly. Discriminating monopoly implies the monopolist charges different prices for his commodity from different groups of consumers. That is first degree, for different users, second degree at different places, third degree. So it can be any of the above. Correct answer is D, Delhi. All three are correct. All three are discriminating monopoly. All three are representing price discrimination exercised by the monopolist in case of two different segments of the people, whether it is from individual to individual or user to user or a wholesaler to retailer on the basis of quantity or on the basis of location. Either way, it is part of a monopolist strategy to apply price discrimination. So any of the above can be applied there and can be called as discriminating monopoly. So question number 31, answer is D, Delhi. Then question number 32, price discrimination will be profitable only if the elasticity of demand in different submarkets is different. Naturally, then only the price discrimination will be profitable. When the elasticity of demand is same in both the markets, price discrimination is not possible and not profitable also. When the price discrimination is possible, in one case, elasticity should be high, where the low price will be charged. In other case, the elasticity should be low, where high price can be charged. That is how the price discrimination will work. So elasticity should be different in two different markets in case of price discrimination to work profitably. So B, Bangalore is the correct answer for question number 32. Then question number 33. In the context of oligopoly, the kinked demand curve hypothesis is designed to explain the price rigidity. Kinked demand curve itself is that. Price rigidity. There will not be much of a changes in the price. It is going to be a rigid price. For a long time, it will be the same price because of the higher price elasticity. After that also the price will be sticky. So that price rigidity is one of the characteristics of oligopoly. And what is the proof of that? Kinked demand curve or demand hypothesis. That is 33rd question. Answer is B, Bengaluru. Then question number 34. If a firm is in a perfectly competitive market, it is a price taker. We know that. And the designation of price taker is based on the assumption that naturally there are so many buyers and sellers in the market that the individual firm cannot affect the market. That is why we are calling it as a price taker. Direct question. Then question number 35. Suppose that a demand curve for a XYZ company slopes downwards and to the right. So we can conclude that definitely what we can say, it is not in perfect competition. That we can say. Remaining thing else we cannot say. So that what we can say, that is XYZ company is not a price taker in the market because it must lower the prices to sell the additional units of output. Then only it can sell more units. If it wants to sell more units, the only way for it to do is lower the prices. And that way it is not in perfect competition. And we can say that it is not a price taker. That is question number 35. Answer is C. Then look at this. This type of question actually I would like to skip and not really go with that because this can be debatable. Ideally, hopefully, such kind of questions should not be given in the exam also. Okay, I know you will tell me what if it comes. I would say you do what you want to do. I will not explain such question because I have my own problems with that. I can argue other way also, whatever the answer could be. So that's such type of questions. Whatever you think, you can just put it. Is it a monopolistic competition? Quite possible. We can call that. Definitely. Monopolistic competition, we can call that. But if the answer is oligopoly, I cannot help it. So whatever it is, different types of brands are there, which are all having a reasonable market share. But we don't know anything about them. We know only names, nonsensical names, shiny bread, Toothpaste, and all that. From that, we cannot conclude anything exactly what it is. In general, yes, it could be a monopolistic competition. Let me not waste more time on such nonsensical questions. Let's move on to another conceptual question, that is 37th question. Kinkard demand curve model of oligopoly assumes that the response of consumers to a price increase is more than the response to a price decrease. Yes, that is also one of the points of oligopoly. When there is a price increase, definitely the customers will move to the competitive product. But when there is a price decrease, that does not mean people are all coming to the other product. So response of price increase is more than the response to a price decrease. That is also one of the things explained by Kinkard demand curve model of oligopoly. Very important concept that also. So question number 37, answer will be B, Bengaluru. Then question number 38. A firm encounters its shutdown point when it should shut down. Simple. Where the average variable cost equals to the price at the profit maximizing level of output. Means average variable cost and price are equal. If the price is not more than average variable cost also, if it is not more than average variable cost also, then there is no point of firm continuing the operations. Better to shut down. That is the correct answer. 38th question, B, Bangalore. Then 39th question. Suppose that at the profit maximizing level of output, so what is profit maximizing level of output? Always that is where marginal cost is equal to marginal revenue. That is already what we know. That is profit maximizing level of output. At that level, a firm finds that market price is less than the average total cost. Naturally, when the price is less than average total cost, but greater than average variable cost, then what the firm should do? Should it shut down? No, it should not shut down. If as long as the price is more than average variable cost, the firm should continue, though it makes losses. When the market price is less than average total cost, that means it is making losses, but still it should continue. So the correct answer is the firm should continue to operate in the short run in order to minimize its losses, not to maximize its profits, because there is no profit there, it is loss only. Still, to minimize the losses, at least to cover some portion of fixed costs, it should operate since the price is more than average variable cost. So 39th question also very important technical question. D, Delhi is the correct answer. Then question number 40. When the price is less than average variable cost, simply shut down. There is nothing. Since it cannot even cover the variable cost if it stays in the business. When the price is less than average variable cost, shut down. No point of production. It is not even able to cover the variable cost. So better thing is to shut down. D, Delhi is the correct answer for question number 40. Then question number 41. A purely competitive firm's supply schedule, I told you already. It is almost similar to the marginal cost curve. That is an important question also. Supply curve for a purely competitive firm will be similar to the marginal cost curve. So D, Delhi is the correct answer. Direct question. Then one characteristic not typical of a oligopolistic industry is horizontal demand curve. No, oligopoly does not have a horizontal demand curve. Which will have horizontal demand curve? Perfectly competitive firms have a horizontal demand curve. Oligopoly will have other things. There may be too much importance to non-price competition. Price leadership could be there. And small number of firms will be there in the industry in oligopoly, but not a horizontal demand curve for sure. So A is the correct answer for 42nd question. 43rd question, the structure of the toothpaste industry, once again. Toothpaste industry, whatever it is, we are not once. For this, we need to do a research paper and then we get PhD, not CA foundation. So if at all we prove that toothpaste industry is, let us say, monopolistically competitive, if I want to prove that, I will get PhD. So it's not a CA foundation level point. Just to give examples in the classroom for easy understanding of the students, it is okay. I also take examples, shampoo, shoe, toothpaste. We can tell that, but we cannot exactly tell it is monopolistically competitive also, whether it is oligopolistic also, we cannot tell that. That is wrong on our part to judge without having any data in front of us. When you don't know, we don't know. As simple as that. So 43rd question also, nonsensical question. Should not be answered, should not be asked also, ideally. Then the structure of cool drink industry is one thing also should not be asked, but at least it is oligopolistic. That is clear since we have only two, because Coca-Cola and Pepsi, only two are there. So 44th question, D can be the correct answer. Still, I don't like such kind of questions, which are not really telling the other data. Nobody is supposed to know what is a cool drink market. This is not a general knowledge exam, technical exam this is. But yes, most of the people know that. But toothpaste and all, who knows? How many toothpastes are there? Everybody knows. We don't know. I know few brands, you know few brands. Maybe some brands are more popular in UP. Some brands are more popular in Punjab. We don't know. Maybe there is some brand somewhere in Tamil Nadu which nobody knows. So this is nonsensical. We don't know everything about all the things in the country, about all the products and brands. If somebody says that I know, they themselves are fools. So that is not correct. So let us not go into that kind of questions. Cool drink is at least okay, because there are only two things, major brands dominating the entire market, Coca-Cola, Pepsi. So we can say oligopolistic, reasonably okay question. Then 45th question, which of the following statements is incorrect? Incorrect. So it is always beneficial for a firm in perfectly competitive market to discriminate prices. First of all, that much possibility itself is not there for a perfectly competitive market, because discrimination of prices happens where? That happens in monopoly, not in perfectly competitive market. So that statement itself is nonsensical. That is incorrect statement, not correct. Because discrimination cannot happen in perfectly competitive market. It happens only in monopoly, exactly opposite. Then 46th question, under perfect competition, in the long run, there will be no supernormal profits. So B is the correct answer, Bengaluru. In the long run, no firm can get supernormal profits under perfect competition. That is 46th question. 47th question. When dash, we know that the firms are earning just normal profits. When is that? Naturally, when the average total cost is equal to average revenue, equal to, then normal profits. When the average cost is less than average revenue, cost is less than revenue means supernormal profits. When average cost is more than average revenue, that means losses. When average cost is equal to average revenue, that is normal profits. So logical question. So 47th question answer is A. Then 48th question, when we know that the firms must be producing at the minimum point of the average cost curve, so there will be productive efficiency. When can be assured that productive efficiency is there? That is where the marginal cost is equal to average cost. Efficiency is related to the production concept, not to the sale concept. When we can say that the marginal cost, when we can say that at the minimum point of the average cost curve should be there of producing at what point there will be productive efficiency. So the answer is marginal cost is equal to the average cost, where the marginal cost is cutting the average cost curve. We know that. That is where is the lowest cost point, and that should be the place. Beyond that, it should not be further manufacturing. That is a place of productive efficiency. So answer is B, Bengaluru, where marginal cost is equal to average cost. Then 49th point, when there will be allocative efficiency. See, productive efficiency is related to costs. Profits is related to cost and revenue. Allocative efficiency is related to where marginal cost is equal to price or average revenue. Where the description is given. The cost of the last unit exactly equal to the price. Consumers are willing to pay for it, and so that the right goods are being sold to the right people at right price. What do you mean by the cost of the last unit? That is marginal cost. What do you mean by the price? That is average revenue. When these two are equal, that's what it means, allocative efficiency. The question itself gave the hint. Answer is C. Marginal cost is equal to average revenue. Then question number 50. Agricultural goods market depict the characteristics close to. Once again, we cannot judge that, but in general, perfect competition, at least on the ground that most of the goods are homogeneous in nature. Again, you cannot say, normal rice, basmati rice, how can they be homogeneous? Not in that sense, but in general, most of them are homogeneous in nature. So we can say at least close to what is used. Close to perfect competition, yes. A is the correct answer for question number 50. Then question number 51. Which of the following is not a characteristic of a competitive market? Not. What is telling? Firms generate small but positive supernormal profit in the long run. No way. In the long run, supernormal profits are not possible in the competitive market. Only normal profits are possible. So C is not a characteristic of competitive markets for question number 51. Then question number 52, which of the following markets would most closely satisfy the requirements of a perfectly competitive market. Once again, practical things cannot be really judged always on the basis of the description. But yes, once again, because of homogeneity. Electricity, we cannot say perfectly competitive because number of buyers are not there. There is only one or two suppliers. Cable television, also we cannot say perfectly competitive. It is monopolistically competitive nowadays. So a lot of people are there. Or in some areas, it is monopoly. Cola definitely is oligopoly. So perfectly competitive, we can say, is kind of milk. Again, is it perfectly the correct answer also? I cannot say. But because the four others are there, all put together, mostly, closely, which can be perfectly competitive is milk because it is homogeneous. There cannot be like too many varieties of milk. Yes, there could be possibility of milk, high fat, low fat, medium fat. Those are different. But basically, the milk is agricultural type of product, which is in general considered to be perfectly competitive market. Then question number 53. Which of the following statements is accurate regarding a perfectly competitive firm? Once again, price is given and determined by the equilibrium in the entire market. That is it. That is a main characteristic. Price is given means fixed. The price is not going to be determined by the seller. It is going to be determined by the equilibrium in the entire market. So D, Delhi is the correct answer for question number 53. Then question number 54. The market for hand tools, whatever it is dominated by, let us say, three different people. Only three are dominating. That means it is an oligopoly. C is the correct answer. Example type questions. 55th question. A market structure in which many firms sell products that are similar but not identical can be known as monopolistic competition. Similar but not identical. Soaps, but all of them have their own separate qualities. That can be considered as monopolistic competition. Many firms sell. If it is same question, but a few firms are there, that becomes oligopoly. So 55th question answer is A, monopolistic competition. 56th question. When an oligopolist individually chooses its level of production to maximize the profit, it charges a price that is less than the price charged by monopoly. Naturally, that much of high price the oligopolist cannot charge, but more than the price charged by competitive market. So somewhere between the monopoly price, which is higher, and perfectly competitive market, somewhere between that will be naturally both monopolistic competition also and oligopoly also. Prices wise, that is how they will be generally there. Generic question, nothing technical about it. So 56th question answer is D, Delhi. Then 57th question. In the long run equilibrium of a competitive market, the firms operate where? At the intersection of the marginal cost and marginal revenue? Yes. At their efficient scale? Yes. Zero economic profit? Yes. All of the above are correct. So, in the long run for a competitive market, everything will be equal, as we can see. Marginal cost will be equal to, marginal revenue will be equal to, average revenue will be equal to, average total cost. Everything will be same. And zero economic profit will come in the long run. Nobody can get supernormal profits in the long run from a competitive market. So D, Delhi is the correct answer for a 57th question. All of them are characteristics of a perfectly competitive market. Then we have 58th question. Which of the following is not a characteristic of a monopolistically competitive market? Not a characteristic of a monopolistically competitive market, it says. Abnormal profits in the long run will not happen in monopolistically competitive. They can only happen in monopoly. Abnormal profits in the long, abnormal means supernormal. Profits in the long run can happen only in monopoly. They cannot happen in monopolistic competition also. They cannot happen in even perfect competition also. So this is not a characteristic of monopolistically competitive market. That is abnormal profits in the long run. So any monopolistically competitive market also can earn normal profits only in the long run. So B, Bangalore is correct answer for question number 58. And 59th question, direct question. In a very short period, the market supply is fixed. Supply cannot be changed in a very short period market. Once again, like perishable things like eggs, milk, vegetables, fruits and all. Very short period market, let us say. Supply is fixed. It cannot be increased very quickly. And some other things like time element was conceived by Alfred Marshall is a general knowledge question. Just remember that. There's nothing to explain what is Alfred Marshall and all. What is time element also is not exactly clear in that question. But that question is given. So answer is B, Bombay or Bangalore for that. Total revenue is price multiplied with quantity. Common sense question. That is total revenue. Average revenue is the revenue earned per unit of output. That is also a direct question. Average revenue can be symbolically written as total revenue divided by Q. Direct question. Average revenue can also be known as price. Once again, direct question. Most of these questions are somehow to fill the number of questions they have been given. Not much popular, but yes, direct questions. If like that, if they can be asked, we can answer them quickly. We can save time in that. Then the other comes the marginal revenue can be defined as the change in the total revenue resulting from the sale of an additional unit of commodity. That is what is marginal. Marginal means always 1 plus. By selling one more commodity, whatever the additional revenue that can be generated, that is called marginal revenue. So B, Bangalore is correct answer for question number 65. Then very important, this one, 66th type of question. When E is greater than when, what will be the marginal revenue? For that, first of all, we should remember the formula for that. What is marginal revenue is going to be? That is going to be average revenue into E minus 1 by E. Right? When E is greater than 1, E minus 1 will be definitely positive. When that is positive, everything will be positive. So the marginal revenue will be positive when E is greater than 1. Then the next question continues in the same way. When E is equal to 1, then marginal revenue is how much? Substitute in the same thing. When E is equal to 1, 1 minus 1 is 0. 0 divided by 1 is 0. 0 multiplied with R is 0. So marginal revenue is 0. No marginal revenue in that case. When E is equal to 1. When E is less than 1, then E minus 1 will be negative. When that is negative, marginal revenue is also negative. So 68th question answer is A. All three questions are based on the same formula, which is marginal revenue is equal to average revenue into E minus 1 by E. If numbers are given also, we should be able to substitute and get the answer for such kind of questions. If theoretically asked also, we should be answer them like 66, 67 and 68th questions. Now 69th question in economics, the market refers to what? Simple. Where the place buyers and sellers bargain for a product or service for a price. In general, in economics, that is one of the conditions for a market where the buyers and sellers will have a bargain for the price. So 69th question answer is A. Then question number 70. Under the perfect competition, a firm is the price taker but not price maker. So that is clear. Under the perfect competition means the firm is a price taker but not a price maker. So 70th question answer is B. Monopolist is a price maker. So 71st question answer is A. Price discrimination is one of the features of monopoly only. Other type of markets cannot have price discrimination. That is a feature of monopoly only, and that also is an important concept. Price discrimination can happen only when the elasticity of demand in two different markets is different. So monopolist will charge higher price where the elasticity is low and lower price where the elasticity is high. That is concept of price discrimination, very crucial. Then under 73rd question under monopoly, degree of control over the price is definitely very considerable because monopolist is a price maker, not a price taker. So very considerable degree of control will be there for monopolist on the price. And once again, 74th question, perishable goods like butter, eggs, milk, vegetables, what we can call them, those all will be generally available in local market. Generally is always we have to keep in mind. Whenever we take an example, there will be always exceptions. Somebody may say Amol is manufacturing somewhere in Gujarat or Rajasthan and now it is selling everywhere in India. It's national market. Okay, everything can be answered. Everything there is an exception. But in general, perishable goods are having a local market. In general is the word to be focused there, not to find out exceptions. Exceptions will always be there. Then question number 75. Look at this question, very important. At a price P1, the firm should produce how much? Very, very crucial thing. Price P1. At a price P1, where is this price P1? This is the price P1. Okay. What is the situation there? What is the average variable cost? It is more than price P1. Average variable cost AVC is more than P1. When the average variable cost itself is more than price, then better to not produce anything. So what is the correct answer? Zero output is better to produce. That is A answer for question number 75. Why? Because average variable cost itself is more than price. Our price is less than average variable cost. It should never produce. So zero output is the correct answer for that question. Then some other direct questions like secular period is also known as very long period. Very short period is also called as market period. Long period is called as secular period. Stock exchange market is an example of a regulated market. That example we have taken already. Market for the ultimate consumers, final consumers is called as retail market. Direct questions. The condition for pure competition is what? There should be large number of buyers and sellers and free entry and exit, not exist, exit. Homogeneous product should be there. Both A and B are the features of pure competition. So C is the correct answer for question number 79. Then pure oligopoly is based on what type of products? Homogeneous products. Pure oligopoly is homogeneous products. Almost we can say Coca-Cola, Pepsi is also a pure oligopoly. There will not be much difference. Black color drink, Coca-Cola, Pepsi. Something like a green colored bottle, similar taste, Sprite and 7-Up. Something like orange colored drink, Fanta and Miranda. So not much differentiation will be there. It's a kind of pure oligopoly. Homogeneous products will be there. Little difference will always be there, but almost homogeneous. Homogeneity is the feature of pure oligopoly. And if in only oligopoly where industry is dominated by one large firm, which is considered as leader of the group, that is not called as oligopoly fully. It is called as a partial oligopoly. These are the definitions of different types of oligopoly. And if they are asked in the exam, you should remember these things also. If there is only one firm which is a leader of the group, then it is called as a partial oligopoly. That is one kind of oligopoly. Where the products are sold through a centralized body, then that is called as a syndicated oligopoly. Syndicated oligopoly means one centralized body is selling the products. All of them are contributing to that centralized body, all the producers, and that centralized body is selling the products. That is called as syndicated oligopoly. Usually we see this in the weaving industry. Lot of cloth weavers and sari weavers, they themselves will not sell. They will manufacture and they will sell all of that to a particular market. That will be generally like a society. And that society will sell to the ultimate consumers. So the selling happens through a centralized body is called as a syndicated oligopoly. Then 83rd question, when the monopolist divides the consumers into separate sub-markets and charges different prices in different sub-markets, what it is called as third degree of price discrimination. Naturally, different markets is distinguishing. Different persons, if he distinguishes, it is first degree. Different quantities, if he distinguishes, it is second degree. Different markets, if he distinguishes, that is third degree of price discrimination. So 83rd question correct answer is C. Then 84th question, under dash, the monopolist will fix a price which will take away the entire consumer's surplus. That will be the first degree because he knows the other person can pay, and the consumer surplus will be wiped out by the monopolist by charging higher price from that person who can afford it. And that generally happens 1-to-1. It happens to us also. Let us say if you have a more ability to pay to certain person, then that person senses that you can pay, he will charge higher. Somebody just getting down from a car and buying a dozen bananas will be definitely charged a higher price than somebody just walking and buying the same dozen bananas. So the banana seller knows very well, though he's not a monopolist, as an example I'm telling. So they know very well the person who can afford will have higher consumer surplus that will be wiped out by charging a higher price. That is called first degree of price discrimination. Of course, price discrimination is related to time also, size of the purchase also, income also. So any of the above can be the subject matter of price discrimination. So D, Delhi is the correct answer for 85th question. 86th question, the firm and the industry are one and the same. Firm is same, industry is same. In where? Only in monopoly, because there is only one firm, which itself is industry. So D, Delhi is correct answer for 86th question. 87th question, the demand curve for a monopolistic firm will be downward sloping. Monopoly also, monopolistic competition also, everything will be downward sloping. So B, Bombay is the correct answer for question number 87. Question number 88, if the average cost is higher than the average revenue, then what happens? Average cost is higher than average revenue. You have to just think, don't just jump to conclusion. When cost is more than revenue, that is loss, no? So C is the correct answer, simple. When cost is more than revenue, that is loss. Revenue is more than cost, that is profit. So firm incurs loss when the average cost is more than average revenue. 88th question, C will be the correct answer. 89th question, which of the following statements is correct? So price rigidity is under important feature of monopoly. No, it is an important feature of oligopoly. Selling costs are possible under perfect competition. Not much. They are possible. Again, possible is not a good word. They're always possible, but less. They're less in perfect competition. Under perfect competition, the factors of production do not move freely. No, nothing like that. So which is the correct one? An industry consists of many firms. Very generic statement. So 89th question answer is D, Delhi. Now the last question, question number 90. Which of the following statements is incorrect, he says. C is the answer here. Why is that? Look at it. A commodity is offered for sale under a perfect competition will be heterogeneous, he says. It is exactly opposite. No? In a perfect competition, the commodities will be homogeneous. They are not heterogeneous. So when it says it is heterogeneous, it is an incorrect statement. Hence, that will be the correct answer for our 90th question, which is C. With that, we can conclude this today's discussion of chapter 4, 3 different units and 90 MCQs we discussed today. Of course, earlier we discussed the other chapters, and we can conclude the quick revision or rapid revision, whatever we can call, of business economics as a whole. And I'm going to just open your unmute option for some time. Maybe a couple of questions are.
So what are all the examples of unregulated markets?
Unregulated market.
Yes, sir. Yes, sir.
Anything which is not regulated is unregulated. How can there be an example of that? For regulated market, we can have examples because it is regulated. For unregulated market, anything which is not regulated is unregulated. Whatever you just go and buy at the end of your street, or a normal vendor who is coming on a bicycle and selling fruits, everything is unregulated.
Yes, sir. Okay, sir.
Sir, please can you explain the degree of price discrimination, stage 1, stage 3?
3 degrees, right? First degree is about person to person. Okay. First degree is an individual choice, wherein, let us say, we enter into a doctor's clinic and doctor think, well, please mute yourselves. Okay, I'm going to mute everybody then. Please mute yourselves. If you are not asking a question when I am talking, please mute yourselves. Everybody cannot talk at the same time, right? These are the problems with technologies, I know, but stay calm. Listen, everybody listen. Once I complete this answer, then maybe you can ask another question. So first degree of price discrimination happens person to person, and the entire consumer surplus of the consumer will be wiped out by charging high price from him. Second degree price discrimination happens on the basis of quantity. Wholesalers will get lesser price, retailers will be charged a higher price. That is known. Normally quantity discounts will be there. If a normal person goes and purchases something, will pay high price. If you pay 1 pen, whatever the price is charged. If you buy 1,000 pens or 10,000 pens, the price will not be same. There is a price discrimination based on quantity. Third degree price discrimination is based on location or market segment also. So depending upon the market segment or location or different markets, if discrimination is happening, that is called third degree price discrimination. For example, Toyota uses price discrimination in India and other countries. In India, Toyota is considered to be a luxury car. So in that, it will encash the additional price that it can charge from the Indian consumers. In other countries, Toyota may not be really that luxury car. It may be a general car, very regular car. So there it will not charge very high prices as it charges in India. Like that, multiple companies will have different pricing strategies in different countries. So that is a third degree price discrimination. Nandishwaran.
Okay, sir.
Sir, in third MCQ.
Please, one of you. I'm going to call the names. Nandishwaran, please go ahead.
Yes, sir. Sir, in third MCQ.
I am not able to hear you properly.
So allow the chat option so everybody can write.
Marginal revenue is minus scroll, sir.
Oh, this is not good. I'm going to do one thing. I'm going to remove the option of unmute and I will allow the chat. You may type and I'll answer now. That is better. Yeah, because the voice is very distorted and yeah. Hello.
Sir, can you hear me?
You can type and ask.
Yeah, please. Any doubts, you can
Yes, sir.
type it here. Yeah. Nandishwaran, you can type. Or others also. Question number 78, 2.91. No, we are on the chapter 4 today, so not possible to go back today. Accounting cost, explicit cost, and other things. I explained already, Vaishnavi Sharma. That was very detailed, explained in the earlier session itself, and a couple of examples also we have taken today also. Accounting, that was in the part of theory of cost. I don't know whether you missed it or what. That was very much in detail explained. Maybe you can. Kinked demand curve, you're not getting. Actually, I'm also not getting. It is like that. Oligopoly has a kinked demand curve. That's it. Leave it there. Don't worry much about kinked demand curve. It is basically what? For a long period of time, the price will remain same. Price rigidity. That's what is shown by the kinked demand curve. Nothing to think much about oligopoly, because as I said, these are not practically possible to observe a lot of times. Yeah. Third MCQ option -12 and 12. Of course, -12. I told you already that. If the third MCQ asks, has an option of -12, you have to choose -12. Since minus is not there, we choose 12. How to manage everything, that's a different discussion, Mayur. I can definitely tell that or generally give some gyan on that, but separately, not now, because we are focusing on economics only now. First lecture of business economics is already uploaded. It's already uploaded. You can go through that. It is there. Vamshika, it is already uploaded. It is there, and you can just check that. Nandishwaran, 6th MCQ. 6th MCQ. What is that? Suppose that sole proprietor is earning a total revenue of 1 lakh and incurring explicit cost of 75,000. That means its accounting profit is 25,000. So that is one thing. Then the owner could work for another company 30,000, means there is a total economic cost of 1,05,000. When the revenues are 1 lakh, economic costs are 1,05,000. The loss is economic loss of 5,000. Maybe you can just listen to that once again. It was, I think, wherever there is economic profit, accounting profit, I know it is a point of confusion for many people. That is why I explained slowly. So just all that you need to do is listen to it once again, just repeat it, and you will be able to get it very easily. That's not a big deal at all. Aravinda is asking whether will there be any complex questions, or these questions which we have covered in 4 days is enough. See, we have covered all the questions given in ICA material in these 4 days. If anybody asks anybody that whether something is enough, answer is always no. But only to get few marks in the examination, possibly yes. But how many marks, that nobody can tell. So no teacher will tell you that this is enough. You do this, you are going to just get succeeded, unless it is ill-intended. So I will not tell like that. Knowledge is an ocean. We can keep on learning and practicing anything, whatever is in front of us. Yet to start with, yes, definitely this is the basic thing that we are supposed to do. All questions from ICA material, not just known the answers, why, each of the answers, if you know why, then automatically is covered. That will be more or less the similar standard of questions we can expect in the exam. Also, let us understand one thing, Arvinda, it is going to be like at least 40 questions which are normal questions. All 60 will not be very complex. No? That 40, can we get 35 out of that? That should be okay. No? Out of 65, if we get 35, 40, that is fantastic. Enough. I mean, to pass at least. To that extent, it's okay. Getting good scores and all, yes, you require a lot of more practice and it rigorous. And don't go by question answers. Maybe that is one more point and problem a lot of people are used to in our education system. Question answers is only just a final test of what we know. Preparation and revision is all about subject. Question answers is only the expression of it. If you just think that by practicing 200 questions, I will get good marks in foundation, absolutely wrong. Impossible to pass foundation exam, for that matter, any exam where you know only question answers. You should know concepts and understand them, read the study material well, and if you are expert of that, if not expert, at least a good understanding of that is there, then any question we can answer and get good score. Business cycles, Harleen was asking, business cycles already covered in the first session, which is already uploaded into YouTube. You can check that. Every firm will go through downward sloping curve phase. Depends. Again, you cannot generalize everything in economics. That is definitely depending upon the situation. Normally, yes. Normally, every firm goes through downward sloping only, because when you decrease the price, then only people buy. Otherwise, they don't buy. So, in general, yes. But we cannot say every firm. Nothing is concrete 100%. When we talk about social sciences like economics, you cannot with 100% confidence say this is correct, that is correct, this will happen like that. It is not natural science or physical science. This is not physics or chemistry. If you have 2 atoms of hydrogen and 1 atom of oxygen, you will get water. Whether you mix it, I mix it, somebody in America, Alex mixes it, you still get water. But it is not the case with social sciences like economics. A lot of different complexities will be there. So my point is, we restrict our study to the things which are required. That is better at this level. When we get more and more understanding of economics at later stages, that will be definitely better knowledge, and broader perspective will come later. Thank you, Madhu. Thank you very much for your compliment or feedback. Supermarkets are located throughout the country. Can it be called as regional market or a national market? It can be called as a national market also, because they're purchasing and selling throughout the country. Anyway, it doesn't make any difference. I still observe so many questions are realistic in nature, practical in nature, which is very good, and types of, I would say, kind of interesting also. But these things are good when we are in a classroom, normally just having a lot of time to discuss these things. When we are looking at a subject in front of examination, what is reality actually happening in the world, for the next 1 month, you keep it aside. Think about what is there in front of us as a textbook, and questions and answers, how we can get best concepts out of this. To that extent, yes. To that extent, yes. Thank you. Definitions and all, I think Herlin is asking, you don't need to by heart definitions. First of all, you are not going to write anything. No? Understand the nature of the paper also. This is a MCQ paper. It is not +1, +2 or 10th standard paper where you have to by heart and vomit. You don't have to. Just understand things. That is enough. Don't try and worry about by hearting, remembering, memorizing. At least this paper, you don't have to do that. Some other papers maybe, yes. For example, law may require a little bit of memorization in chartered accountancy also, but not foundation economics. You don't need to by heart anything. Just remember what they told. If you understand essence, that is enough. Thank you. I think with that we can conclude. It's already 8:20. Thank you very much, everyone. Hope you will prepare well and write exams well also. And in case, I mean, I'm sure you do not have that much requirement. If at all you have a requirement, you know how to search. Some of the videos related to the detailed economics classes are there on YouTube. You can search my name and other things also. And in this particular rapid revision batch also, all the 4 videos have been uploaded to the YouTube. And you can get the kind of classes that you want according to the requirement. Prabhu is asking now, price determination, is it part of demand and supply? It is a result of demand and supply. Price is determined through demand and supply only. No? So definitely demand, supply concepts put together is price determination. That's how the markets work. Yeah. Fine then. With that, I will conclude today's session, and all the best for your examinations. Thank you very much.